Hey everyone, Larry Walsh here, Chillnomics. So the Federal Reserve today announced another increase in the prime interest rate. They've hiked it up another 75 basis points, or 0.75%. This is the third time in a row that they've done this. The entire point of this is to take money out of the economy. They're trying to make it more expensive to get money, and in doing so, decrease spending. Decreased spending will decrease demand, which would then bring the inflation rate down. Now, why is that important? Well, inflation should be around 2.5%, and right now it's riding around 8 to 9%. And that's overheating a lot of the economy and putting a lot of pressure on businesses and individuals. People can't afford gas, they can't afford food. Going back to their employers, looking for wage increases. If the employers get wage increases, then it's going to spiral even higher. Now, the problem we have is that what is the Federal Reserve actually trying to do? And what they're doing is that in cooling down the economy, they are trying to get us to a soft landing and avoid a recession. And this is even many economists are even saying that a recession could be avoided, at least in the United States, and they're also saying in China. Western Europe is an entirely different story. This I don't know if is actually a possibility. I'm a bit skeptical of this. In fact, the reason why I'm skeptical of it is because we're now hearing from some sectors of the economic analysts and pundits that they're now worried about deflation. And deflation will be that there will now become a surplus of goods out in the market, but there will be no money or people to buy them, which will then cause even more problems. Um, a lot of this is really problematic and something that we here at Channelnomics have been talking about now for months, that we have to be cognizant of the recessionary pressures, that the recessionary conditions that we're already operating under, that there is going probably more likely than not, there will be a recessionary event sometime in the near future. We've already passed Q1 and Q2 having negative GDP, which is the classic definition of a recession, that once you have two consecutive quarters of negative GDP, technically they say you're in a recession, but it really is up to this special board of economists actually to officially declare that we're in a recession. Um, we're still thinking that there's going to be a lot of pressure, downward pressure on sales, on new sales. Could be collateral pressure on renewals in technology. I think there's also probably going to be a lot of pressure on vendors and resellers to find new sources of revenue while at the same time cutting costs, which is going to affect service delivery. So the outlook is not changing, but the catalyst, the influencers on what is causing all this will change. Almost feels like it's changing day to day. But that's the take on what the impact is on the latest rate hike. Again, this was baked into the equation. We knew this was going to happen, and chances are the Fed will probably try doing this trick again in October and probably again in November until they start seeing that inflation rate come back down from its current 6 to 8%, 8 to 9%, down to its target rate, which is about 2.5%. Probably won't see that until sometime next year at best. So if you're interested in learning more about how you can weather the economic storms that are coming, survive the recession whenever they decide to declare it, we do have our channel recession survival guide. It's available on our website, channelnomics.com. And we also have our new Channelnomics CFO service, which helps vendors quantify their cost to serve channels and optimize their operations so they can get the most out of their indirect routes to market. And these are just a couple of things that are available. There are other things from Channelnomics as well as other providers. They're all here to help you get through these uncertain times. Yeah, I suggest you check them out. So until next time, I'm Larry Walsh here at Channelnomics.